Good morning, friends. I am Nandish Shah, derivative and technical analyst at HDFC Securities. Today, I am going to discuss how the market is looking from the derivative side after a rise in volatility over last 2 days. So let's straight away jump to the presentation. We have seen long build-up in the Nifty futures during the May series till now, where we have seen 26% rise in the open interest with Nifty rising by 0.86%. On the other end, we have seen short build-up in the Bank Nifty futures during the May series till now, where we have seen 10% rise in the open interest with Bank Nifty falling by 0.79%. Now coming to option data, Nifty open interest put call ratio fell sharply to 0.85 levels on Friday from 1.33 levels last week. This sharp fall in put call ratio is largely on the back of call writing at 18,200 to 18,300 levels, indicating 18,200 to 300 level to act as an immediate resistance going forward. On the other hand, Nifty is likely to find an immediate support in the vicinity of 17,800 to 18,000 levels where puts have been written. So as you can see from this option distribution chart, we have seen put writing at 17,800 to 17,900 levels, while aggressive call writing at 18,200 to 18,300 levels. Long build-up is seen by the FIs in the index future segment during the May series till now, where the net bought was rupees 323 crore with their open interest going up by 47,000 contracts. However, if you were to see the breakup of the index future segment, they have created fresh longs in the Nifty futures while created fresh short in the Bank Nifty futures. You must be knowing from the month of February, NSE has started giving FIs separate data of Nifty and Bank Nifty futures. FI's net long to short ratio in the index futures rose to 0.82 levels from 0.75 levels at which we began May series. So though it has risen sharply from the March lows of 0.10, it still stands below the 1, which indicates higher possibility of a more short covering in the coming days by FIs. So as you can see from this chart, FI's long to short ratio moved to as low as 0.10 on 29 March. It recovered sharply to 1.05 levels on the back of aggressive short covering by FIs and cooled down a bit to 0.82 levels on Friday. So though FI's long to short ratio moved up sharply from the low, it is still below 1 and therefore it indicates higher possibility of short covering from FIs in the coming days. So coming to outlook, as we discussed earlier, we have seen long build up in the Nifty futures, put writing at 17,800 to 18,000 levels, long build up by the FIs in the Nifty future segment, and FIs long to short ratio, it is still below 1, so indicates more short covering from them. All these indicators indicates that downside is limited in the Nifty and one should remain optimistic for the market for the coming days. Therefore, our advice is to remain bullish and accumulate longs on decline with the stop loss of 17,700 levels. On the higher side, 18,200 to 18,300 level to act as a strong resistance where we have seen call writing. Any close above 18,300 level would result into further short covering, which might push Nifty to even 18,500 to 18,700 levels. Now coming to Bank Nifty, we have seen short build-up in the Bank Nifty futures, call lightning at 43,000 to 43,500 levels, and also short build-up by the FIs in the Bank Nifty futures. All these indicators indicates that for Bank Nifty, one should remain cautious till it closes above 43,200 levels. On the downside, 42,000 to 42,200 level to act as an immediate support, where we have seen put writing. So for Bank Nifty, a close below 42,000 or close above 43,200 will dictate the clear trend. So on the one hand, we are bullish on the Nifty and our advice is to accumulate longs on decline with the stop loss of 17,700 levels. While for Bank Nifty, the data is bearish. Therefore, our advice is to remain bearish till it closes above 42,200 levels and on the downside 42,000 level to act as a strong support. Now coming to sectors, there are four sectors where we have seen long build up during the last week and they are auto, capital goods, fertilizer and power. So traders should look at stocks from this sector to create a fresh long positions if market were to correct from here on. This is all I want to share from the derivative side.